As a self-employed person, you actually have access to retirement accounts that could allow you to save more than most of your friends with 9-to-5s, significantly more. But most solopreneurs either don't know that, don't use it, or pick the wrong account and leave thousands of dollars on the table every single year. Hey y'all, I'm Nikita with Collective, and today we're breaking down the 4 main retirement plans built for self-employed people. But remember, everyone's situation is different, so this isn't personalized financial advice. But we will cover what the options are, how they work, and which one could be the best fit for your situation. All right, let's go. So, there are 4 retirement plans to have on your radar: the Traditional IRA, the Roth IRA, the SEP IRA, and the Solo 401k. Each one works a bit differently, has different contribution limits, and has different implications for your taxes. And like most things in finance, they are not one size fits all. So let's break them down one by one. Let's start with the most familiar one, the Traditional IRA. An IRA is an individual retirement account. You open it and fund it yourself, and your money grows over time, invested in whatever securities you choose, like stocks, index funds, or ETFs. With the Traditional IRA, the money you put in is pre-tax, meaning you get a deduction now, you lower your taxable income today, and you pay taxes on the money when you pull it out in retirement. The contribution limit for 2026 is $7,500 a year, or $8,600 if you're 50 or older. You can set it up and fund it all the way up until April 15th of the following year, and still count it toward the previous tax year. But here's the thing, the Traditional IRA has a pretty low ceiling. $7,500 is not going to build you a retirement on its own. And if your income is too high, your ability to deduct the contribution can get limited or cut off entirely. So it's a solid starting point, but it's not the heavy hitter here. Now, let's talk about the Roth IRA. Same contribution limits, but a completely different tax strategy. With a Roth IRA, you don't get a tax deduction now. Instead, you contribute after-tax dollars, so there's no immediate savings on your tax bill. And when you hear that, it's easy to think, okay, then what's the point? The point is what happens on the other end. When you retire and start pulling money out of your Roth IRA, every single dollar, including all the growth, comes out tax-free. If you put in $7,500 a year for 30 years and your account grows to $600,000, you pay 0 taxes when you withdraw it in retirement. That is especially helpful if you expect to be in a higher tax bracket later in life, or if tax rates go up in general over the next few decades. While there aren't barriers to contributing to either plan, how much you make may impact if or how much you can deduct from a contribution. The income limit in 2026 is $153,000 for single tax filers and $242,000 for married couples filing jointly. So if you make too much, you can't contribute directly. And if you have both a Traditional and a Roth IRA at the same time, your combined contributions are still capped at $7,500. You can split it however you want, but the ceiling stays the same. Okay, really quick, if you're still with me, go ahead and give this video a quick thumbs up and subscribe to get more content just like this, specifically designed for solopreneurs. Okay, so the IRAs, both are great and both are pretty easy to open at most brokerage firms with no setup fee. But if you're a solopreneur with real revenue and you want to put away some serious money, you need to look beyond those Traditional IRAs, which brings us to the SEP IRA. SEP stands for Simplified Employee Pension, and it's built specifically for self-employed people. Instead of capping you at $7,500, a SEP IRA lets you contribute up to $72,000 for the 2026 tax year. But how you get there depends on how your business is taxed. And this is where people get tripped up. One thing to understand about how SEP IRAs work: contributions always come from the employer side, not the employee side. You can't chip into your own SEP IRA the way you would with a traditional or Roth IRA. The business makes the contribution on your behalf. Since you're self-employed, that means you're wearing both hats. You're the employer making the contribution, and you're the employee that's receiving the contribution. Now, if you're running as a sole proprietorship or a single member LLC, meaning your business taxes are grouped with your personal filings, your SEP contribution is based on your self-employment profit. At a high level, that's what you bill your clients, the revenue, minus your business deductions. Here's where it gets a little circular though. The IRS says you can contribute 25% of your compensation, but for self-employed people, compensation is defined as your net earnings after subtracting the SEP contribution itself. So the contribution reduces the number it's calculated on, which reduces the contribution, which changes the number again. It's a loop. When you actually run the math on that loop, it resolves to roughly 20% of your net earnings before the contribution. That's not a different rule. It's just what 25% of the post-contribution base works out to be. So here's how to think about it in practice. Take your net self-employment earnings and multiply that by 20%. That's your ceiling. Let's put a number on it. Say you're a single member LLC owner with $80,000 in profit, the amount after business deductions, and the self-employment tax adjustment. 20% of that is $16,000. That's your SEP IRA contribution limit for the year. Now, if you have an S Corp, this part is actually simpler. Because you pay yourself a W-2 salary, compensation means exactly what it says, your salary. No circular math, no adjustment. You just take 25% of your W-2 and that's your limit. So if your S Corp pays you a $60,000 salary, your SEP IRA contribution cap is $15,000. Here's where it gets interesting though. Your W-2 salary is doing double duty. A lower salary reduces your FICA tax burden. That's the self-employment tax savings that makes the S Corp election worth it in the first place. But a lower salary also shrinks your SEP IRA contribution ceiling. So you're balancing two things. The less you pay yourself, the more you save on payroll taxes, but the less you can put away for retirement on a pre-tax basis. That's why setting your reasonable compensation isn't just a compliance checkbox. It's actually a planning decision. The IRS requires that your salary be reasonable for the work you do. And there's real flexibility within that range. Where you land inside that range can be intentionally shaped by your full financial picture, including how much you want to contribute to retirement, which means if maxing out your SEP IRA matters to you, that's a legitimate input into the salary conversation and a good reason to work through it with someone who really knows what they're doing. The SEP IRA is also flexible on timing. You can set it up and fund it all the way until the due date of your tax return. So if you file an extension, you have until your extended deadline to make contributions that still count toward the prior year. That's a lot of runway. Now, let's switch to solo 401k, which is my favorite to talk about. The solo 401k, sometimes called a solo K or an individual 401k, is designed for business owners who have no full-time employees other than themselves, and in some cases, a spouse. And what makes it so powerful is that you get to contribute in two separate ways: as an employee of your own business and as the employer. As the employee, you can contribute up to $24,500 for the 2026 tax year. That's your employee deferral, and it goes through your payroll. You decide how much you want to set aside each pay period, and it comes out pre-tax, meaning you get a deduction for it in the year you contribute. As the employer, you can contribute an additional 25% of your compensation on top of that. So, using that same example, if you take a $36,000 reasonable salary, your employee contribution could be $24,500. Your employer contribution could be $9,000, and your total contribution would be $33,500. Compared to the traditional IRA's $7,500. We're talking about a difference of $26,000 in contributions, which at a 22% tax rate could translate to thousands in additional tax savings just from choosing the right retirement account. Now, your employee contribution deadlines here can get a little bit confusing depending on how you're compensated. If you receive W-2 compensation, your contributions will need to be submitted each time you get paid. If you receive self-employment compensation, your deferral election must be placed by the last day of the year, though the actual contributions don't need to be funded until your tax return due date. Employer contributions can be made up until the tax filing deadline, April 15th, the following year. And here's one more thing about the Solo 401k that a lot of people sleep on. You can also set up a Roth version of it. A Roth Solo 401k lets you make those same employee contributions on an after-tax basis, meaning the growth and withdrawals in retirement are completely tax-free. So even if you make too much to contribute to a Roth IRA directly, you can still get that tax-free retirement money going through a Roth Solo 401k. So let's quickly recap all four so that you can keep this straight. The traditional IRA is easy to open, $7,500 max, reduces your taxable income now, you pay taxes in retirement. Good starting point, but a low ceiling. The Roth IRA has the same $7,500 limit. No tax break now, but tax-free growth and withdrawals in retirement. Handy if you're playing a long game. And these both can still be used in addition to SEP or 401k if you really wanted to maximize savings for later. But the deductibility and tax impact may not be present or as great. It depends based on your motivation. Maximize tax dollars saved or maximize retirement contributions. For example, the SEP IRA is built for self-employed people, up to 25% of net earnings or $72,000 max, with much higher contribution limits and flexible deadlines. Great for sole proprietors and freelancers with solid income. The Solo 401k for S Corp owners and self-employed people with no other employees combines employee and employer contributions up to $72,000 total and has the highest potential savings. But like I mentioned in the beginning, the right one depends on your income, business structure, and what ultimately is your long-term tax strategy. What does that look like? There isn't one universally correct answer. But what I can tell you is that the worst choice is no choice at all, meaning don't not do something and miss out on years of tax advantage compounding because it feels complicated. Start somewhere, open something, and then work with your tax professional or financial advisor to optimize it as your income grows. If you found this helpful, be sure to give it a like and subscribe. We cover this kind of stuff all the time: taxes, business structures, how to actually build wealth as a solopreneur. We love it all. And if you want to see how Collective actually helps self-employed people handle the back office side of their business, I'm going to drop that link for our bookkeeping and taxes and all of that S Corp stuff down in the comment below so you can get a full description. See you in the next one.